Greetings, everybody. Welcome to our webinar on Basel 2.5 and Basel 3. The agenda that we will cover today with you can see in front of you the context for the new regulations put forth by the Basel Committee on Banking Supervision, the timeline of those recommendations as a function of the financial market crisis that we all endured in 2007 and 2008. We will talk a little bit about the strengthening of Basel II, which we all call Basel 2.5. We will go through the highlights of Basel III, comprehensive steps towards bank stability. We will talk about the implementation of these recommendations and have a look at where banks stand in terms of the new regulations at the current time. The context for new regulations, of course, was driven off the back of so many banks getting in trouble in 2007, 2008, 2009. This chart shows you the percent of banking assets in each country which were either government assisted in the light color or failed banks in the dark color. And with so many countries running somewhere between 20% and 80% of all banking assets in the country needing to be assisted by governments in order to stay alive or actually failing, the regulatory community was invited to rise up and address this and see if by stronger regulations we can prevent such carnage ever happening again. The world began to show signs of trouble already in 2007. We had a failure of a mortgage bank in the United States. We had the two Bear Stearns hedge funds going down in the third quarter of 2007. We had the Fed introducing the term auction facility, the very first attempt of the Federal Reserve Bank to provide liquidity to the market already before the end of 2007. And we had a lot of banks either failing or being taken over or supported by governments during 2008. And the market risk framework for Basel II, the strengthening, Basel 2.5, was proposed already about the middle of 2008. And the framework for Basel 2.5 was finalized by the third quarter of 2009. And the Basel III consultative document followed shortly and was implemented or finalized by December 2010, and then a few more changes by June 2011. So we can see that the regulatory changes are certainly a response to the difficulties that financial institutions faced around the world. Under Basel 2.5, we are talking about a stronger market risk management framework. And the focus of that was to increase the amount of risk-weighted assets that banks are deemed to be holding and therefore increase the amount of capital that they have to carry. The specific elements addressed several items, but we had credit default swaps where an incremental risk capital charge was spelled out to try and capture default risk and credit strength migration or transition risk. We had capital charges against trading book securitized products like CDOs and asset-backed securities to bring the capital treatment of those products in line with what it would be on the banking book if the bank was making loans to borrowers like that. And we also had an enhanced value at risk or stressed value at risk capital charge where banks are forced to calculate the value at risk in their market risk trading portfolios using a one-year period of market distress with higher volatilities like we saw in 2007, 2008. Basel 2.5 was implemented for European banks at the end of 2011, so their 2012 statements are in full compliance and will take effect in the U.S. beginning on the 1st of January 2013. Most banks in U.S. and Europe are already trying to report what their capital situation looks like under Basel III. So even though the regulations haven't yet taken effect, the information is being promulgated. Under Basel III, we are trying to make banks more stable, and they have gone down 5 or 6 different routes, which are all designed to make it very unlikely that a too-big-to-fail bank is going to need government subsidies to keep it alive. The first one is to force banks to carry more common equity Tier 1, CET1 capital, with the base requirement rising from 2% to 4.5%, and with the addition of a capital conservation buffer. The capital requirements on derivatives counterparty credit risk have been raised, and for the first time banks have to recognize the potential losses on their client derivatives business as a asset that has to have capital against it. The whole financial system has been deleveraging since the crisis, and the regulators are joining that hue and cry by imposing a maximum leverage ratio. The too-big-to-fail bank problems with banks that have to be protected by the government is going to be addressed by adding a capital charge for systemically important banks, and we will see those identified both globally from the BIS and domestically from each of the various domestic supervisory authorities. We are also going to potentially see banks have to hold capital to protect them from a eventual credit market bust whenever credit markets grow very, very quickly, as they were doing prior to 2008, with the addition of a counter-cyclical capital buffer. And finally, we have efforts to protect banks from the massive freezing of liquidity that we experienced in financial markets by 2 new standards: a short-term 1 month liquidity coverage ratio, and a longer 1 year net stable funding ratio. More on each of those as we make our way through the presentation. In terms of common equity Tier 1 capital, the biggest change is from Basel II, where there was a 2% against risk-weighted assets common equity Tier 1 capital requirement, into Basel III, where the base requirement is more than double at 4.5%, and we have imposed a capital conservation buffer, which also must be common equity Tier 1 capital. So we've in effect jumped from 2% to 7% of risk-weighted assets that has to be supported by common equity Tier 1, basically common shares and retained earnings. Under Basel II, we had a 4% Tier 1 capital requirement, not just common equity Tier 1, but including other forms of near common equity type capital. And that 4% capital requirement has now been raised to 6%. In addition, we have the 2.5% capital conservation buffer, so Tier 1 capital is up to 8.5%, more than double its 4% level. And finally, total capital under Basel II was 8%, and that included Tier 2, and if banks wanted, there were also provisions for Tier 3 capital, which was available only to support market risk. The 8% number has now jumped to 10.5% when we consider the Tier 2 capital as well as the capital conservation buffer. So the requirements for banks to capitalize the business at a much higher level are going to be a major impact because, of course, capital is a very expensive form of finance. The capital conservation buffer of 2% is designed to force banks to hold more capital up to the 7% level if they want to pay dividends on their common shares or other types of distributions on other types of equity. The 4.5% capital level is the minimum required, but if you don't have 7%, you may not pay dividends. So it's forcing people to carry more capital. The counterparty credit risk comes in the form of CVA, which is now going to be included under risk-weighted assets. And CVA, of course, is the market value or present value using market rates and spreads of the expected credit loss on a bank's derivative portfolio. And the reason that's now going to be captured is that the BIS realized that most of the losses that banks took during the crisis from derivatives counterparty credit risk were not actually realized losses, but were instead CVA losses, and only about 1/3 were due to actual defaults. Now the entire picture will be supported by capital. Leverage ratio looks at the balance sheet plus certain off-balance sheet commitments like potential future exposure on derivative products, and says that banks have to carry common equity tier 1 capital equal to at least 3% of their total balance sheet plus other items. The other capital requirements, of course, don't look at the balance sheet, but rather at risk-weighted assets. U.S. banks have already been forced to hold tier 1 capital at a 4% level against total assets and on the balance sheet, and that will continue. The risk-weighted assets under Basel III are compared to risk-weighted assets under Basel I for the U.S. or 2.5 in Europe, and as you can see, under Basel III, most banks will be reporting a fairly larger amount of risk-weighted assets. For Bank of America, the jump from Basel I to Basel III is a 26% increase. For Credit Suisse, 13%, UBS, 40%, Citibank, 27%, and JP Morgan, 28%. So many of the banks will be reporting higher risk-weighted assets, and of course they have to hold more capital now against higher risk-weighted assets. Just for reference, we show you also the size of the balance sheet comparing to risk-weighted assets, and all banks are showing fewer risk-weighted assets than they show assets on the balance sheet. The reason for that, of course, is under Basel II, the risk weights that are assigned to loans and bonds issued by various borrowers are mostly not 100%. And under Basel II, the differentiation was by credit rating. Under Basel III in the United States, that has to be changed because, of course, Dodd-Frank has forbidden banks to use any reference to external credit ratings and instead have to calculate their internal ratings-based versions. The idea that too big to fail banks cause problems is addressed by a couple of measures. One is on a global scale. Systemically important banks have been identified. The identification process looked at various indicators, including how big the banks are, their interconnectedness, their dominance of various markets such as derivatives trading, the global scope of their business activity, and the complexity of their mix of businesses. And based on those ratings, banks have been identified as systemically important banks. The same process will happen domestically, and we will have domestic systemically important banks and, frankly, other financial institutions, which may pick up some insurance companies or other large funds. And those banks are subject to a further Common Equity Tier 1 capital charge known as the GSIB capital charge. The capital charge ranges from 1% for banks in Bucket 1 up to 2.5% for banks in Bucket 4. And it's on a sliding scale. There is a further bucket above 2.5%, which is reserved for banks that make themselves more systemically important and will require that they hold even more capital against their risk-weighted assets, and is frankly designed to discourage any of the banks in Bucket 3 or 4 from becoming larger and more systemically important. But this means that Common Equity Tier 1 capital requirements, even ignoring the countercyclical capital charge for banks in Bucket 4, will be 9.5%, and that is, remember, up from 2% under Basel I and Basel II. How well are banks doing against this new the new capital charges? Well, these are some of the Bucket 2 banks who have reported where they stand relative to fully loaded Basel III CET1 ratio requirements. And as you can see, most of them are fine. Credit Suisse was down at 7.5% at Q3, but they will be showing full compliance even with the higher Swiss requirements by the end of 2012 or early 2013. Bucket 2 banks are Barclays and BNP Paribas, and both are in line to be compliant. Barclays has a little bit more to go, but they expect to get there by retaining earnings. The issue is with Bucket 4 banks. Of course, they have this 9.5% common equity Tier 1 capital requirement and are making their way there, with the obvious exception of Deutsche. And Deutsche expects itself to be fully compliant based on earnings power, but that's over the next year or two. Citi and JP Morgan Chase would like to say they are fully loaded Basel III compliant, certainly by first quarter 2013, if not earlier. The countercyclical capital buffer will be imposed by domestic regulators if they judge that credit has been building up at an excessive pace. The example of this, of course, is 2006 into 2007, where credit was available at very cheap rates and in seemingly endless supply. And when domestic regulators see that happening again, they can slow it down by imposing up to another 2.5% common equity Tier 1 capital charge against risk-weighted assets. The goal is to stop credit from building up too fast, which eventually destabilizes the banking sector. That in turn causes recession, and that of course feeds back and destabilizes banks even further. Finally, we have the liquidity coverage ratio and the net stable funding ratio. The LCR looks at a 30-day horizon and basically requires banks to hold high-quality liquid assets that could, if required, completely fund their needs to pay cash out in the normal course of business over a 1-month period, even in a time of market stress. The net stable funding ratio is a similar requirement, but it looks at the liability side of the balance sheet and says we want to ensure that your liabilities are sufficiently long-term to cover the assets that you are holding, meaning we don't want banks to be funding illiquid assets using short-term or overnight wholesale market funding, as we saw with Northern Rock and then far more large scale with Lehman Brothers. This is a dangerous situation, and this NSFR is designed to address that. How well are banks doing? Where do they stand right now? This table comes from the Basel Committee on Banking Supervision. It's done as of the end of 2011. I think the situation has improved since then. But what you can see is that for a group of banks that did a voluntary filing, it was 209 banks, 107 in Group 1, which are banks with more than 3 billion euros of capital, and Group 2, another 102 banks. Where do they stand on fully loaded Basel III compliance? And the answer was, well, they need another 374 billion euros of capital in Group 1 for CET1, and the Group 1 banks earn about 350 billion a year, so that's more than a year's worth of earnings before distributions like dividends. With Group 2 banks, it's a 21.7 billion shortfall, which is a little less than 1 year's worth of earnings before distributions, which is about 24 billion euros. So we still have a ways to go. I think the next edition of this table will show a strong improvement or drop in the capital shortfalls. Challenges that banks face from market observers. We had a couple of interesting recent papers submitted by McKinsey and Boston Consulting Group. The Tier 1 ratios by the end of 2011 are up globally from 8.2 to 11.7. Carrying more capital means, however, that in a continuing difficult time for banks to make money and rise their income, the return on equity has dropped from 13.6% in 2007 to 7.6% today in 2011. The capital markets return on equity in 2007 was 20%, and that is down to 7% for 2011. So it's harder to make money, and therefore having to carry a lot more capital means it's very difficult to pay a decent return on equity to your investors. That is not going to make it easier for banks to continue to raise equity, obviously. The global bank capital shortfall was assessed by BCG at 474 billion euros around the world, of which 256 was with European banks. So clearly that is the source of a lot of stress. Finally, this is the table that shows the transition arrangements, or when each of these requirements must be complied with. And as you can see, they are phased in over 6 years, with the minimum CET1 ratio coming in for 2015, but the capital conservation buffer not really hitting its full 2.5% level till 2019. GSIB additional CET1 capital requirement comes in as well in 2019, and the countercyclical capital buffer will grow starting in 2016, although at the current time, with banks holding cash rather than making loans, I don't think any domestic authorities are going to be assessing that or believing that the credit is growing too quickly. Leverage ratio is official as of 2018. The liquidity coverage ratio kicks in 2015, and the net stable funding ratio 2018. The observation periods indicate that they will potentially make further amendments to how they calibrate those or calculate those ratios before they become official. That concludes our short webinar today on Basel 2.5 and Basel 3. I hope this is useful to you and wish you a good day. Thank you.
Great, thank you, Patrick. We will go straight into questions now. The first that's come through is, do you think economic growth will be hampered by Basel III bank capital standards?
I think that it is always a problem when economic growth has to be supported by bank lending, and it is obviously going to be harder for banks to make a profit by growing their assets because they're going to have to grow their capital at the same time. So it can't possibly be a easy relationship, although the economic growth at the moment isn't being held back by banks' reluctance to make loans. One day we hope that we will have to deal with that problem.
Thank you, Patrick. Another question that has actually come through is, what is the timeline when changes must be made?
The timeline is shown on the table here, and there are two aspects to that. Obviously, for full compliance with the new regulations, banks have some time in order to get their act together and work with their domestic regulators. That said, many banks have vowed that by sometime in either the beginning or early 2013, they want to show that they are able to be fully compliant on a fully loaded basis with Basel III, and are trying to get there right now.
Thank you, Patrick. Another question which has come through In your view, how will Basel reforms affect insurers?
How will Basel III affect insurers? Well, insurance companies, of course, are subject to separate regulation, which has been updated recently as well, Solvency II. And yet, at the same time, I think they will be impacted by Basel III in a couple of ways. One, several of them are likely to be deemed domestic, systemically important financial institutions, D SIFIs, maybe even G SIFIs, and could therefore become subject to regulation by the banking authorities as well as the insurance authorities. In addition, they will be in their trading business and their derivative trading business, insurance companies will certainly be impacted by the requirements, which we have not spoken about today, to move all of the derivative trading onto central clearing houses and use margining against all derivatives trading. So I think those are ways that insurance companies are likely to be impacted by Basel III.
And thank you, Patrick. I think looking at time, I think we can get another question in. The final question is, what is the main weakness of Basel III in your opinion?
Well, the weakness of Basel III is maybe best understood in terms of the strength of Basel III. What the regulatory community has tried to do is make banks into fortresses that are not going to be subject to the types of risk that we saw in 2007, 2008. And that, of course, means that they will be forced to carry a lot more capital and will not be able to earn money in any way like the way they were doing before. The implication of that is hard to spell out, and many of our listeners today may have either observed or seen or read about the infamous exchange when Ben Bernanke was giving a press conference in New York, and the first question was asked by Jamie Dimon of JP Morgan Chase, and his question was exactly that: does anybody know exactly what the implications are for banks of all the new regulations that have been proposed? And of course Mr. Bernanke answered that no, he was not aware of anybody who actually could spell out what all the implications are and what it will mean for banks in a infamous exchange.
Thank you very much for that, Patrick, and thank you very much for all of you who have joined us today across the world. We've had an extremely good response, and glad to see that so many of you were able to join us. Finally, it just leaves me to say, as a leading provider of knowledge management, Intuition does offer numerous types of services relating to learning solutions, anything from online courses and tutorials, learning portals, mobile learning, and the classroom tuition. For more information of these, or if you'd like to discuss your current learning strategy requirements for 2013, please do contact us on info@intuition.com. That's info@intuition.com. Thank you all once again, and goodbye.